Hello, chart watchers, and welcome to this Tuesday, April 9th, 2019 Market Watchers Live Show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got a little bit more selling going on in the market today. We have the Dow Jones Industrial Average down 164 points, the S&P 500 down 14, the Nasdaq down 19, and the Russell 2000 down about 7. 10-year Treasury yield rolling over. We're trading at about a 5-day low on the yield, currently down nearly 3 basis points, 2.49%. Volatility coming back up, testing about a week and a half high around the 14 level, although we have backed off, but we are still up almost 4%, up 0.5 on the day on the VIX. Leading to the upside, we have communication services trying to make another breakout. This has been a really strong group so far in April, and it is going against the selling trend today. And we are seeing some strength in that group. To the downside, energy leading along with industrials. These are the two weakest sectors. We did just see a breakout on energy the last 2 days, but we are pulling back, trying to hold on to that breakout level. Among the individual stocks today, Cerner Corp. I'll talk about this one in just a bit, but it is the top performer on the S&P 500, up nearly 10% today. Pentair announcing a warning about the upcoming revenues and earnings, and you can see that stock getting hit by 14%, the weakest stock on the S&P 500. And then the leader on the Dow today is Walt Disney, and I'm not going to steal any of Erin's thunder. She will be talking about Disney in her upgrades, but the upgrade did lead to a breakout to a multi-month high in Disney today, and that is certainly helping the Dow on a relative basis. All right, Erin, it's 2 days away from the start of the Masters. I'm excited. I'm excited about the market, but I'm also excited about the Masters.
Yes, I know. We're going to probably be talking about it all week, aren't we?
Yes, we probably will, and that's why my workshop was named Narrowing Down the Field, because I am going to narrow down the Masters field as well.
There you go. There you go. Yeah, I'm just, like I said yesterday, tomorrow night, the hockey playoffs start. So despite the Ducks not being a part of it, I just enjoy hockey so much. I can't wait to watch all of the great games.
Yeah, it should be good. Of course, my Capitals won the Stanley Cup last year, so we're going to be defending this year.
Mm-hmm.
And, we did win our division. Not the best record in hockey, though, so we've got some work to do. Tell you what, Tampa Bay is strong. That is.
I was just going to say, I think it's a foregone conclusion they're going to win the Cup. It'll just be interesting, the struggle they have to get there.
Yeah, I mean, last year it was the same way going in. I didn't think we had much of a chance against them. We're not going to catch them by surprise this year, though. So it'll be interesting. But they're a really, really, really strong team across the board, offensively and defensively. So that's going to be a tough matchup for anybody for sure.
Indeed.
All right. Well, I know I got my workshop, and we got tons to go over today. So let's get started.
Yes. Tony Dwyer will be here tomorrow. Roman Bogomazov will be here on Thursday. He is one of the Mr. Wyckoffs. So if you like Wyckoff, you'll want to definitely tune in on Thursday. Today, Tom is going to start off after the technical news with his workshop on narrowing down the field. 10 and 10, our first symbol will be TJX, if you want to go take a look at that. And then finally, I will finish off with the scooter report. So stick around. Looks pretty good today. Why don't we get it started, though? Technical news and headlines.
All right. Yeah, there really wasn't anything out in terms of economic news, and only one earnings report, Shaw Communications, SCTR. So let's go ahead and pull up first the 10-year Treasury yield and just see what's going on. I mentioned just a couple minutes ago, you can see that we are currently at a 5-day low on the yield. We're down at 2.49%, just below what we've seen throughout this week. We've been going sideways on the yield after a nice little push to the upside. I did want to just go over the RSI for a minute, because not just with respect to the yield here, but on any chart, one of the things you want to look at for the RSI is when you're in a trendless market, the RSI tends to go between 30 and 70. So here you can kind of see we really weren't doing a whole lot. And you can see the tops peaked out with RSIs around 70. Bottoms, you can see when we got to an RSI 30. When you get more into an established uptrend, however, you'll see that the RSI routinely will go above 70. And when we pull back here, we held 40. before finally topping, getting that double top, and then breaking down. In a downtrend, look at the RSI move below 30. And when we rally and move back to the upside, we struggle to get through 60. So currently, even though, and I just wanted to point this out because 10-year Treasury yield certainly has had a little bit of a bias to the upside over the past couple of weeks. But the way I view this is that we're still in a downtrend. We've got some work to do to, I think, reverse this downtrend that we've been in and start to look at this as more of an uptrend. First thing we would have to do is we'd have to clear that 2.55% level. And then secondly, we need to get back up above the 50-day, and ultimately the 20-day has to get above the 50-day. You can't have an uptrend with a shorter-term moving average below your long-term moving average. And you can see ever since we made this cross below on the 20-day, the 20 has remained below that 50. So I would say 10-year Treasury yield remains in this downtrend, even though we've seen some strength in the yield the past couple of weeks. And it's not to say that the market can't go higher. My goodness, we've seen the stock market continue to go higher despite the 10-year Treasury yield breaking down. But when the yield is rising, especially off of low levels, what it's telling us is that money is rotating away from Treasuries, and that can really help to fuel equities going forward. So that's why it's so important to keep an eye on it. It's why we talk about it every single day here on the show. But for now, we do remain in that downtrend. All right, in my blog this morning, I talked a little bit about energy, and I just wanted to point out a chart here because I'm going to talk a little bit about this as well when I get into my workshop. But the XLE, I think you can look at this and see that we had a nice recovery off the December low, and we've been trending higher. I think that's pretty clear on an absolute basis. But what might not be so clear, and I know there's a lot of folks getting excited, energy prices, crude oil prices jumping, energy breaking out to multi-month highs. This is exciting, right? Well, it's exciting, except even with the uptrend, the XLE relative to the S&P 500 remains in a downtrend. And you can see back in the fourth quarter of 2018, while the market was going down, while energy was going down, it was actually going down even faster than the S&P 500. And where we were at the end of the year, even with the surging crude oil prices, energy has barely outperformed the S&P 500 on the year. And each one of these relative highs keeps going lower. And the big reason for it is the dollar. So back when we saw all of that horrible relative weakness in energy in the fourth quarter, it was accompanied by a rising US dollar. And when you look at 2019 and all of these peaks, these relative peaks getting lower, look at the bottom on the dollar index continuing to rise. So one of the things that I look for is I try to find outperforming areas of the market. And when I say outperforming, I mean outperforming the benchmark S&P 500. So even though energy has some catalysts to take it higher on an absolute basis, I think the rising dollar is still keeping a lid on energy in terms of relative strength. So if we saw this trend line break to the downside on the dollar, I would grow much more optimistic energy on a relative basis. Just wanted to point that out because I do think it's important. Sometimes we get caught up in a breakout saying, oh, this is awesome, when in fact, even though we're getting a breakout on an absolute basis, we're not getting that breakout on a relative basis. So money is not rotating greater than its fair share. That'd be another way of looking at it. So I continue to be very cautious on energy and materials because of the dollar. Crude oil prices going up is great. Dollar breaks down, then I think we got something in energy. Until then, I think I would still pay attention to that relative strength line. All right, let's pull up a chart on Cerner because I talked about this one at the very open. Top performer in the S&P 500. I'm going to stretch this chart out a little bit. Just go back to last year. Because when you look at it, we didn't quite get up to that high in August. And I'll be honest, this kind of an announcement, they said that they agreed with their activist shareholders, Starboard Value, to shake up its board of directors and cut costs so that they can improve margins. They also announced that they'd be boosting their buyback by $1.2 billion. So a lot of noise, a lot of words. I don't know that necessarily translates into a 9% gain, or at the high today, that was probably up 57 to 66, $9. That's probably about 18% or something earlier today. Maybe not quite that much, maybe 16%. But anyway, the point is it was going up on a lot of rumors. I mean, well, shouldn't say rumor. They had an agreement. But just because you shake up your board and you talk about cutting costs to improve margins doesn't mean you're going to actually do it. So I always use, if I'm in a stock and I get that kind of an announcement, I think it's a sell. I mean, unless we're getting a major technical breakout, which we did not here, I think it's a sell. Now, when we pull up a relative chart on Cerner, I think it's really where this stands out, because it is in the software space. It's a medical software provider. So in the software space, look at what software has been doing. Breaking out well above the high that it saw back in October. Where was Cerner before this announcement? You can see on a relative basis, this has been a horrible stock within software. So yeah, you're getting a news announcement, you're getting a pop. I wouldn't be surprised to see the stock come all the way back down into the upper 50s. We'll see, but there's more to it here. You got to do more than just, talk the talk. I think Cerner's task is going to be to try to walk the walk in the coming months and actually see that these board of director changes and these cost-cutting measures actually do something to improve the bottom line, improve cash flows, and then eventually result in a higher stock price. Again, I think the news sometimes is an opportunity to get out. PNR, Pentair, this one, and I'll pull this up on a relative basis as well. They lowered their revenue and earnings per share guidance, blaming poor weather. Listen to this cut, though, on their earnings per share. They were anticipating, Wall Street was looking for 47 cents to 50 cents. They came out this morning and said, it's going to be more like 30 cents. That is cutting your profits by more than 1/3. And when you consider that market valuations are based on future cash flows, present value of these future cash flows, and all of a sudden now you're taking a 1/3 haircut on your earnings per share going forward, also cutting revenues, not good action. If we look at the industrial machinery group, you can see that the group was actually nearing a high from back in September. We were about that same level on this particular stock, although on a relative basis, PNR was doing a much better job a year ago. And it's been, for the most part, in a downtrend. We had one nice little pop here. We had a little bit of strength at the end of March before we went into April. But April had already started turning lower again before the news came out today. With the news, this is the kind of stock that I would be out of. I think the industrial machinery group relative to the S&P looks pretty good. I mean, we've had a nice relative move in 2019, and we're trying to make a relative breakout. I think that is good. The problem is, I think now with this warning, I believe you have one of the worst stocks in the group, and I wouldn't be surprised to see us go back down and challenge that 35 or 36 area. So something to think about anyway as we move forward. Last thing I wanted to mention, and again, I'll talk about this a bit more when I get into the workshop, but make sure you check in the sector summary each day to see what is going on in the market, where the money is rotating to, where it's rotating from. Now, this is just an intraday look, so I wouldn't draw too many conclusions by looking at what's happened over 2.5 hours, but you can change the periods. We've been going up now for a little over 3 months since that December bottom. So what's been leading during these 3 months? Well, you can quickly see technology has clearly been the leader. Go back 6 months. Now, all of a sudden, we're looking at the period that includes the big meltdown in the final quarter of 2018, plus the recovery in 2019. So what has led over that period? And you can see it's been real estate with a big move to the upside. So even though we're getting a lot of strength coming back in those aggressive areas, real estate's still holding on to the top spot over the last 6 months. Okay, I'm going to get ready for my workshop, but Erin, take it away for the upgrades and downgrades.
Absolutely. And as you mentioned, the first one I'm going to actually go over is Disney today. Oh, and I just wanted to make a remark. I don't know if you mentioned it, Tom, but CERN, sorry, CERN was also upgraded today. So pretty interesting on that news and all of that. But all right, let's go ahead and start off with Disney here. Disney was upgraded today by Cowen and Company from a market perform to an outperform. I have to agree with their assessment here as far as decision point is concerned. I can only see one thing that worries me, but let's go over the things that I like. First of all, that 20-50-day EMA positive crossover, that gave us an intermediate term trend model buy signal. And of course, we got the PMO buy signal that came in, and we're now seeing this breakout above short-term overhead resistance. Next area, of course, would be the high from November. And, looking at these indicators, I would have to say, there's a really good chance we could get there. But like I said, I do have a little bit of a concern, mainly here on the OBV. You've got this declining tops here. And if you look at the corresponding tops, they are rising. So the volume isn't quite confirming this move just yet. We really want to see a bit more volume come in here. And I think part of the problem for the OBV is this area right here. We had so much high volume to the downside, it really pulled back that OBV very low. And so I think we're really trying to just catch up because of this. While it isn't the best to see two tops going down, declining tops on an OBV, I think that, it's just really a matter of catch up. It just hasn't made it all the way to the top. And I don't like ketchup on my French fries, just FYI. All right, let's go ahead and look at PKI. This is Perk Kinelmer, and this is a healthcare sector stock. It was upgraded today by Goldman from a neutral to a buy with a target now of $115. And I like this upgrade. I think that it came just a little late, but we had some attention flags here. The PMO had a buy signal back here. I think that was really good timing. You can see it came right on that breakout from that top we had back here. So at this point now, though, it would be a matter of chasing. I want to see this pull back a bit more, maybe over the next over this next day or two. We'll just see how that goes. But look at the scooter too. It's just moved right up into that hot zone. So PKI looks pretty good here in that medical supplies industry group. JM Smucker was actually upgraded, I believe, yesterday in addition to today. Credit Suisse upgraded it from a buy to a neutral, and their target, it's showing at 120, but we're at 119.71. So we basically already hit the target intraday. But what I liked about this chart is this almost textbook flag here, a continuation pattern off of a rally that had started off that December low, like many of the stocks we know of. The question is, though, is this PMO a little bit overbought? There's one way to check, and that is to increase the period to 6 to 7 years and see where the PMO has been going. And as you can see, it really is a range, at least since 2016, between 4 and -4. And currently we're at 3.68. So yes, we do have an overbought PMO right now, but it is starting to accelerate higher. And as you can see, we have that flag formation. And if you did the, just a quick look as far as the minimum upside target, which would be about the size of this flagpole, that's going to put you right about here testing that 2018 high. So I think that's certainly more than possible, but it is in that consumer staples area. So they're not always the best movers relatively. All right, let's go ahead and move into some downgrades right now. Charter was downgraded today by Macquarie from a buy to a neutral. PMO sell signal. It did just pop above overhead resistance. It did so yesterday and failed. I'd want to watch and see if it could actually stay above that overhead resistance. But, even on this downgrade, we do have a PMO turning up. And as you can see, price is holding now above that 20-day EMA. So I don't think this one looks too bad. They only moved it to a neutral. So JP Morgan overweight to neutral. So they're pulling back a little bit on their look here at HB Fuller Company. And we've got the PMO buy signal, but you can see it's already trying to decelerate, mainly on this decline right here that we're experiencing today. I don't know about this downgrade. I think that there's still, we're in this trading range. At this point, you're sitting right about in the middle. I don't like to get into stocks with a trading range if they're in the middle of it, or certainly near the top of it. SAP was downgraded today by two groups, HSBC and UBS, both downgraded to a neutral on SAP. I am all on board for that downgrade. Notice the PMO sell signal. And of course, watch though here at that 200-day EMA, because that would get us to an area of very interesting support. But it also will be testing the 200. If we can't hold the 200-day EMA, I really don't see much prospect here. But honestly, I would be putting this stock off of my watch list just based on the PMO. All right, and that does complete the upgrades and downgrades. Here are the list of symbols, and I will have this up in the Market Watchers Live recap. All right, Tom, are you ready? Let's see what you have to say today in your workshop.
Okay, well, we are going to jump right in. And so today what I want to do is I want to talk about narrowing down the field, because when you start to invest or you have money to invest, there's just so much to consider, and it seems maybe sometimes overwhelming where to go. And all of a sudden, when you do start looking, you've got one idea, and then you've got another idea, and then before you know it, you got 20 ideas, and you don't have the money to buy 20. And then sometimes you have so many choices, you don't really know where to go. So I just want to talk a little bit about how I go through my process of narrowing down the field. So I am going to talk stocks. I'm not going to talk to masters, as I teased maybe a little bit earlier. But let's take a look first, because in order for me to begin to narrow down, I have to look at the overall market. So I start with a top-down approach. And I want to know what the overall market is doing. Are we in an uptrend? Are we downtrending? Is it sustainable, in my opinion? And if so, then where do I want to go? Where do I want to look at within the market? So here I'm going to start off with a longer-term chart. This is a weekly chart going back 30 years on the Nasdaq. I talk a lot about the S&P, and I try to outperform the S&P, but actually I really prefer watching what's going on in the Nasdaq, because it is a little bit more aggressive. And as long as the Nasdaq's outperforming, I tend to be more bullish, because to me, that's an indication of risk on. And when traders are in a risk on type of mentality, the market tends to do much better. So when we look at this Nasdaq chart, I actually have highlighted these dips, or many of the dips on the PPO, the weekly PPO on the Nasdaq, when it goes below zero. And if you look back, most of these moves coincide with either a cyclical bear market or a secular bear market. SB is indicating secular bear, CB is cyclical bear. And the difference between the two, if you notice on this blow off top of the bull market that ended in early 2000, it just absolutely exploded to the upside. And a lot of times that's what you'll get at the end of a secular bull market. And then you go into what's called a secular bear, where that high at the beginning tends to hold the market back for a dozen years or so. And when you look at this, we had a bear market 2000 to 2002, another bear market 2007 to 2009. And it wasn't until really we got to about 2013, 2014 that we were able to clear that 2000 high on the Nasdaq. So this was a period we were in a secular bear market where we just really never made up any ground. We never took out those prior highs. In a secular bull market, you're constantly moving to all-time highs. And so when you do go through a period of weakness, instead of it being a secular bear, where that's what we typically see during those longer-term periods, a cyclical bear is just a brief counter-trend move to the downside during what is generally just a bullish advance to the upside. So back in 1990, you can see that was a cyclical bear, PPO, weekly PPO, well below the center line. Same thing in 98. That went down 20%. Actually, on the S&P, it went down 20%. I did not check the percentages here, but I can look and see on the NASDAQ, this definitely went down 20, maybe even 30%. But then we went right back up to new highs again. So these are considered cyclical bear markets. Well, I think that what we just went through was a cyclical bear. And I think the weekly PPO moving back up above that center line was confirmation of that. if you look back in these bear markets, especially in the secular bear markets, once you go below that center line, you just don't go rifling right back up through it. The momentum, that negative momentum, extends for a much, much longer period in a secular bear than it does in a cyclical bear. Cyclical bears tend to be almost V bottoms, down, back up. Here, down. Here it was more like an ABC kind of a move to the downside and then back up. In 98, same thing, a little bit more of an ABC and then back up. This year was just more of a V. But in each of the cases, you can see that the weekly PPO goes down below zero. And when it gets back up above zero, the bear market ends. We saw it again those 2 years and then kept moving higher. I think that's what we're doing here. I think we're going to see movement to the upside, take out those highs in 2018, and I think the market's going to be trading at all-time highs and continuing to move forward over the next coming couple years at least. So I am very bullish in the market, and this is kind of one of the charts that I look at just to give me an idea, a sense that when you've got a PPO, weekly PPO, that is on the move higher and it is above zero and rising, that is generally not the time you want to be getting out of the stock market. Doesn't mean we're not going to have down weeks or even a down month here or there, but I believe the overall trend is to the upside. Now, if you look at the PPO at the tops coming across here, if you get above 5 or 6, that tends to mark some pretty euphoric kind of tops, and that's where I would be looking for at least a little bit more selling. Doesn't mean that we're going to have a cyclical bear, but I would just look for more consolidation selling if we get up to that level, because historically that is where the market tends to at least stutter a little bit. But right now I think it's full speed ahead. So this is a pretty important chart to me. Next up, I mentioned the Nasdaq versus the S&P 500. Take a look. This is since we bottomed back at really 10 years ago, and this move to the upside. We have had a couple of periods where we've seen some relative weakness. We saw it in 2014, saw it really for about a year, the second quarter of 2012 through the end of the first quarter 2013 before picking back up. But these are more exceptions than they are rules to this trend. I mean, you can see, I think, that for the most part, the Nasdaq is trending higher relative to the S&P 500, and I think that's bullish. Fourth quarter, that's when we had that cyclical bear. Of course, these types of stocks, the high growth stocks, are going to get hit harder, and the Nasdaq did. But we are rallying back up, and this has been almost a straight line up since that December bottom. So I think money continues to rotate very bullishly and aggressively into the Nasdaq. I find this to be bullish. Now, I mentioned I think yesterday in my blog, and I pulled this up, this is just a 1 year chart, or actually not even that, maybe an 8-month chart. The S&P 500, and what I was pointing out is that the technology group relative to the S&P was rising. So this isn't just saying technology is going higher. It's telling us it's rising faster than the S&P 500. So while the S&P has been having a great rally, technology has been the leader. Consumer discretionary right on the heels, also breaking out to recent relative high in 2019. Communication services, well, we rallied. Now we're just kind of consolidating those rallies, more sideways in 2019 than anything. Industrials, big move up first couple months of the year, came back in March, and now I think we're just kind of settling and consolidating in a range. And then, as I mentioned, financials, the one laggard. But keep in mind, this is a 8-month chart. This is not long-term. This is an 8-month chart. And I'm going to show you a longer-term chart here. This is a 10-year weekly chart. So here's the S&P during the 10 years moving higher. This is technology relative to the S&P. See how it's mostly going higher? Consumer discretionary, mostly going higher. Communication services, mostly going higher, although it's been consolidating recently. Same thing for industrials. If we just look back at the last year, we might kind of get this feeling that, oh, industrials are moving lower on a relative basis, and that's bearish. But I think we're just doing more sideways consolidation than anything. We've done this before. Here was a couple-year period. Didn't look like we were doing anything. Look at this, trending lower for about, I don't know, maybe 20 months before we broke out, moved to a new high. So unless we were to go back maybe and take out those lows, especially that December relative low, I think industrials are fine. Financials, a little bit more challenging, no doubt, but I did add the 10-year Treasury yield minus the 2-year Treasury yield to give you a little bit of sense of why financials tend to underperform in certain periods. If you notice back at the beginning of this 10-year period, 2010, we topped on the 10-year Treasury yield. The next couple of years, we went lower. Well, that lowering of that spread cuts right into the profit margins of banks and life insurance companies. So the heart and soul of the financial sector gets hit when we see these 10-year Treasury yields dropping faster than the 2-year Treasury yield, or rising slower. And so here that that net difference between the two is declining, and financials really struggle then. Notice that when we get into a period where the 10-year Treasury yield is rising faster, we get relative strength from financials. Here we had a sudden move at the end of 2016, and we had a huge pop in the financials. But 2017, 2018 has been more of this downward pressure, and you can see that on a relative basis, financials have been struggling. The final thing I have here at the bottom is just the XLY versus the XLP chart. This is consumer discretionary versus consumer staples. Consumer discretionary, think aggressive. Consumer staples, think defensive. So if the market is in a risk-on environment, meaning that traders are much more aggressive, that tends to take the stock market higher. So when this ratio is overall rising, I am very bullish the stock market. And you can see in 2018, when the market was going up, we had this rising to new highs. We pulled back in the fourth quarter, but held the prior breakout. And now we've started to move back up again in 2019. So nothing really on this chart bothers me about the stock market. I think that we're going to new highs. I don't think that we'd be setting up for a big move to the downside with technology breaking out to a new relative all-time high. Consumer discretionary breaking out to a new relative all-time high. I don't believe we'd be seeing that right before we go into a steeper bear market decline. So I think pullbacks are viable, and I think this trend remains strong to the upside. So using a top-down approach, I am bullish looking at the market, and this is why. You can feel free to disagree. You may have your own things that you look at, but this is why. This is what I'm going to fall back on. And now that we've got strength coming in, relative strength in key areas, I am looking for long positions. I am not looking to short anything. All right, next up, let's talk about the dollar, because I mentioned this a little bit earlier, talking about just the last 8 months or so and what the dollar has been doing here, throughout the end of 2018 into early 2019, and how that's been putting pressure on the relative strength of energy and materials. Well, look at the longer term picture. This isn't just an 8-month phenomenon. This is something that I think is really important when you're looking at bull markets, bear markets, and what's leading and what's lagging. I think you have to follow the dollar. So the last bull market we had, 2002 to 2007, the dollar was declining. I think it's pretty clear the dollar index was declining. Energy on a relative basis led that bull market. Materials on a relative basis led that bull market. But since then, we have bottomed. We went through a 2-year period where really the dollar was kind of going sideways. XLE relative to the S&P and XLB relative to the S&P, both doing the same thing. But once we bottomed in 2011 and we started putting in these higher lows in the dollar, look at the relative weakness of energy and materials. If I'm looking to outperform the S&P 500, am I going to find more stocks on a percentage basis that are outperforming the S&P 500 in technology, or am I going to find more in energy? I can almost assure you that I'm going to have a higher percentage in technology because technology is outperforming the S&P 500. Until the dollar breaks down, I'm not a fan of energy and materials. Have no interest in them. Yeah, an individual stock here or there certainly could be traded. But if I was trading ETFs, if I was sticking to the sector ETFs to manage my portfolio, as long as this dollar remains in an uptrend, I would be severely underweighted the XLE and the XLB. Personally, I wouldn't have anything in them at all. But for those who are maybe, want to be somewhat diversified, I would just be underweighting them. When the dollar breaks down, then I think that's when we get a turn on these two groups. Till then, I'd be careful. So now we've looked at the top-down approach, still, feel bullish about the market. I'm going to eliminate defensive groups, though. Defensive groups tend to underperform in a rising market. I'm going to ignore energy and materials because we've got a rising dollar environment. And I think this chart clearly shows that during a rise in dollar environment, energy and materials lag. So yeah, you're going to get periods where they're going to outperform, but the overall trend is down. So if your timing's perfect, where you catch energy stocks in 2016 when they're outperforming while the dollar is, mostly going lower, congratulations. I mean, for me, the big picture, I'm not going to try to find the 6 month or 9 month window where energy is outperforming, or a 2 month window. I'm going to go ahead and pay attention to the bigger trend. Okay, next up. Okay, so now we've got the aggressive groups, and those are the 5 groups I'm going to key in on. I'm going to be looking at technology. I'm going to look at consumer discretionary. I'm going to look at communication services, industrials, and financials. Financials, I'm going to be a little leery of some of the areas because of the yield and what I showed you on the 10-year versus the 2-year Treasury yield. But there are still other areas of financials, like financial administration, that have been doing extremely well. They're not nearly as dependent on what the Treasury yield's doing. So those are the groups. Those are the aggressive areas. So those are the 5 sectors. 90 to 95% of my trades are probably going to come out of those 5 sectors. I'm really not even going to, as soon as I see a stock I like and I see it's in the material space, I'm probably going to throw it out. Or if I trade it, I'm going to have a very tight stop, because if it starts to roll over, I know that group is an underperformer. Hopefully that makes sense. All right. Let's move on. So if we're looking at an individual sector, let's say technology, what are you looking at? Well, on a price relative chart like this, and that's just taking the XLK and dividing it by the S&P 500 and plotting that answer right here on the chart throughout the last 10 years, I think it's pretty clear that technology has been a leader and has been an outperformer versus the S&P 500. Now, it's been on a roll so far in 2019, and we know going back in history that we do get these pullbacks, relative pullbacks. So it's something that's on my mind, but it's been a great group. So individual stocks, I'm probably going to have a little bit more patience with them than I would say a material stock. So if it's breaking a little bit below price support or a moving average, but the volume is light, or maybe just the overall industry group has been pulling back, and that's bringing my individual stock down a little bit. As long as I'm in what I consider to be a solid industry, I'm expecting that stock to come back. So I'm going to have a little bit more patience, a little bit more tolerance for stocks that are within the technology area. Now, here's a breakout. Now, I wanted to show this chart because this is a weekly chart. So this is a weekly relative PPO. So I use PPOs on these price relative charts similar to PPO on a regular chart. To me, this is just telling us relative momentum instead of just momentum. So when I look at PPO on here on a price relative chart, think momentum, think relative momentum on the RRG. Because when you've got a weekly relative PPO that's above the center line, essentially what that's telling you is you've got a pretty good, in this case, sector relative to the S&P 500. So technology has been a pretty strong group. Well, we know, I mean, before I even looked at this chart, I would have known that the price relative PPO is going to be above zero, because I showed earlier that over the past 3 months, technology is leading this rally in 2019. So I know that on a relative basis, it's strong, and this is confirming it. One thing maybe to pay attention to, though, notice that the relative momentum seems to top out at about 2. And if we get up to 2, that's where we maybe are going to see one of these little pullbacks. See how every time we get up to 2, we struggle on a relative basis? I think that might be something to watch as we move forward. And the reason I bring that up, if we look on a seasonality chart over the last 10 years, keep in mind, this is the 10-year chart I was just showing you on a relative basis. So let's look at the relative seasonality. And what I see here, going back the last 10 years, look at May. This is the XLK relative to the S&P. It has outperformed the S&P 500 in the month of May all but 1 year. And look at the average outperformance. May tends to be very strong for technology stocks on a relative basis. But look at June. June is averages losing 1.1% to the S&P. And over the entire bull market, the technology group has not outperformed the S&P one time. I think that's worth noting, especially if we see this XLK PPO, this relative PPO, relative momentum, get up to that 2 level as we get close to June. That is going to be a great big old red flag to me. If I want to outperform the S&P 500, I may want to take some profits in technology stocks and maybe redeploy in one of the other aggressive areas of the market. That's how I'm going to use the big chart, the big picture. Look at all of the different price relative charts, throw a little seasonality into there to come up with high probability, not guarantee, high probability. All right, so that was the seasonality. All right, so let's take a look. Let's say financials. Let's say the 10-year Treasury yield starts to move up, and all of a sudden financials catch fire on a relative basis. Well, I want to know what areas within financials are performing well, because if all of a sudden the floodgates open and more money comes into financials, that a lot of that money is going to go to areas that are performing really well. So I'm focusing here on specialty finance. Why? Because look at how specialty finance is outperforming the XLF. This is not versus the S&P. This is just telling me that this is one of the best areas within the financials. Now, another way to look at this, I could go into the sector. Actually, let's do the industry summary. And if I look back at the last 3 months and go down to the financials, look at what's on top. Specialty finance, 26.68%. How about if I go back 6 months to take in that horrible period that we saw back at the end of last year? Look what's still leading, specialty finance. So in a down market, it was leading, and in an up market, it's leading. So if the financials start to regain relative strength, I think this is an area you want to at least have representation in. Okay, now before we look at individual stocks or how maybe we could go about looking at individual stocks, let me just go over to the relative rotation. And I just pulled up 4 groups that I think have been performing pretty well in consumer discretionary over the last 3 months and over the last 6 months. Footwear, hotels and lodging, specialty retailers, and restaurants and bars. Now, this is where we stand currently on a weekly RRG. Now, you might look and say, well, these are pointing down and they're in the weakening, but they all go through that at some time. They don't all continually lead and just continue to see strengthening relative momentum, strengthening relative strength. You're going to have periods of money rotating within the consumer discretionary space, but it is nice to see on the weekly, for the most part, these groups staying over on the right-hand side. Now, I'm going to go back at the beginning of the year, or beginning of the last year, starting back in April of 2018, and just show you that it hasn't always been great for these groups. You can see restaurants and bars and hotels did not really participate in the last move to the upside. But when the market started to weaken, look at the restaurants moving just absolutely soaring. So that's telling me that that's a pretty strong group. Now, it is way over here on the right side. It really needs a period of weakening, and I think that's what we've seen. But look at it starting to curl back up again as restaurants start to, as the we move into April of 2019. I think this is a group that's just starting to regain some of its strength. So just wanted to show how on an RRG, and I could show you, let's pull up the one that I just looked at in the financial space. So if I pull up the SP, DJUSSP, and I compare it to the financials, and let's update this on a weekly basis. Look at what this has been doing over the course of the last year. Now, we went through, during that period of weakness, we did have a little lagging period. But as soon as we got to the bottom, as soon as money began coming back into the market, you can see this has been an absolute monster. So this is a group that I want to look at. So whether you use the price relative charts or whether you use the RRGs, they're basically still giving you some really good information. Okay, so how can we use all this information to our advantage? We feel if you at least follow along. You don't have to agree with me. But my thought process is, okay, I'm in a bull market. I'm looking for relative strength. I'm getting it in most of the aggressive areas of the market. I'm looking for some of the industry groups within those sectors that are outperforming. Now, what do I do with that information to try to find investments? If I'm not just investing in ETFs, if I'm investing in ETFs, I'm going to overweight those aggressive groups, those aggressive sectors. Maybe as we head into June, based on what I showed you, I might probably would lessen my exposure in the XLK, but I might look at other areas that tend to perform much better in June that are aggressive to maybe redeploy some of that money, rotate it. All right, so now I've got kind of my marching orders here. I know what I want to look for. And let's just use the DJUSSP as the area that I'm going to try to find a trade in. So this is, and you can see it's continuing to be strong. I'd rather see a pullback, but let's just play along. Let's just go with this group. It's definitely in an uptrend. It's one of the leaders. So now what do we do with specialty finance? Well, there's a couple things we can do. It's been a great performer. So what if we go back to the dashboard and we go into predefined scans? All right, so there's predefined scans. Another way to get into it's down here, predefined scans. So let's pull these up. How about 52-week highs? Now, I don't know if we're going to have any. We'll have to see. But let's go in, and I'm just going to pull up financials first. Financial. And specialty finance. There's one. It's hitting a 52-week high, MSCI. So that's the only one on the list when I pulled up in the predefined scans, the only one that's showing in specialty finance. Scooter rank, by the way, 98.9. It's a large cap stock, so that gives me a little bit of good feeling. Now, maybe it's because it's 52-week high, it might be overbought. Let's take a look at it. And it is. It's overbought. But this is one that I would certainly have on my radar. I would put it into a chart list. If I was looking for candidates to buy, I know specialized finance is an area I want to be in. I know MSCI is one of the strongest. It's got a scooter rank, almost a 99. Add this one into a chart list so you don't forget it. Again, even if this isn't where you want to get in, look what happened back at the beginning of March. Stock was down 4 or 5 days, hit the 20-day. That would have been a great entry into the stock. Here you can see we went sideways to down 6 or 7 trading days. Didn't quite hit the 20-day, but you can see we did at least move from overbought to an RSI down into the 50s. Same thing here on this pullback. We probably got the RSI into the upper 50s there. So it's not necessarily I'm going to go jumping in today because I don't want to overpay and watch the stock consolidate for a period of time. But this is one to keep on a list, a solid stock in a very, very solidly performing industry group. And if financials ever start to get more rotation into them, MSCI is going to be a great candidate. All right, so that's the predefined scan. How about if I went into my strong earnings chart list? So let's say you're keeping a chart list, and we could view all and summary. And I'm going to do specialty finance. Oh, there's 2 of them. MSCI is on my list. Another one is HTGC. I don't know what that one's been doing. Well, that one actually took a big hit. I'd have to go back and see what that volume was all about. I don't know if that's earnings related or what. Let's take a look at the longer-term weekly chart here. Well, it held the 20-week and then came back up above. I mean, I'd have to see what that was all about. I mean, if it missed earnings recently, back a month or so ago, then that might come off my list. But that's another way. I could go back to a chart list and just type in. Again, if you pull up that summary of your chart list and then just type in the industry group. Or if you just like financials because you see financials are breaking out, type in financials. Then sort it by scooter. And you can see here's financial administration that I talked about. 3 different stocks in financial administration with scooters from about 89 to 95. Pull up the chart. Hey, look at this one, pulling back to the 20-day moving average. Might find a trade right here. So that's one way to do it. One final way to go through is to either use the scooters or industry summary. So instead of going to a chart list, what you could do is go into scooter reports. And let's say, you were a fan of small caps. And within this group, you wanted to go into specialty finance. Safeguard Scientifics got a 79.9 scooter in the small cap area. What's that chart look like? Looks pretty good to me. Nice uptrend, higher highs, higher lows. Little bit, another pullback, test the 20-day maybe. Doesn't trade a whole lot, so that probably would keep me out of this stock. But if I ignored volume and just looking at the chart, looks pretty good. And then finally, last thing I wanted to mention is how about if we just went into the industry summary? Because if we go into industry summary under financials and we go into specialty finance, you can see today, by the way, these are the two groups leading, the only two higher on financials. But pull up specialty finance and sort it by scooter. And now all of a sudden, you've got the list of the stocks in this space. How about Moody's, 90? This is another one that's been very strong. So you zero in, you start at the top, you narrow it down to try to get it to a more manageable size, to zero in on an area of the market that you like and a stock within that group that's outperforming. I personally think that is a great way to begin. I mean, if you haven't really gotten into investing in the past, if you're fairly new, I think this is a great way to start in terms of trying to find outperforming stocks. Okay, that is it. So let's go ahead and pull up the summary. I think I went through everything here, started with the top-down approach. We evaluated the dollar throughout the materials and energy area. Using the industry price relative charts, we looked at those 5 aggressive areas, found some groups within those areas, industry groups we like, and then used that in the predefined scans or the scan engine, also the scooter reports and the industry summary to find individual stocks that meet your criteria. So hopefully you enjoyed that. We talk a lot about relative strength. I thought this maybe was just a little different to go through it the way I did today. Let me know what you thought at the end on your survey response. Love to hear from you. And if you have thoughts on different ways that you kind of do the same thing, but maybe do things a little bit differently, let me know. I'd love to hear it. Okay, Erin, it is now time for the 10 in 10.
I have a question in the room for you. Just two. They shouldn't take too long. One is, what do you think about the small cap average volume historically precedes market declines? Have you looked at this volume perspective on, low volume predicting declines?
I've said before that I am not necessarily a fan of looking at volume on indexes during rallies and comparing them to volume on declines. Because if you go back into history, you will see in almost every instance, the volume is much heavier on the downside on major indices than it is to the upside. And so I personally would avoid making those kinds of determinations based on volume. And you just have to keep in mind that when people panic, during declines, they panic, they sell. When they start feeling like, oh my gosh, the market's going to where in a handbasket, I got to get out. I need to be out. I'm just selling. And I know everybody who's traded the market has had those moments where you're just like, I know I have, and it still happens from time to time where I'm just like, okay, I'm just selling everything.
Yeah.
Get out. And you don't do that very often on the upside. Not too many people panic on the buy side.
That's true. And I think one way to get around that a little bit is trading the ETFs of those indexes. I think they're a little bit better about that. That's my opinion. The last one was, do you look more to the foreign markets in a strong dollar environment, especially China?
Well, John Murphy touched on that a little bit the other day when we had him on the show, and certainly John is much better at that than I am. So I would defer to following John Murphy as far as investing. That's really not my specialty. I'm not going to try and tell you that that's something that I do regularly. I focus exclusively on the U.S. stock market.
Mm-hmm.
I mean, I will say this: if you're investing in foreign ETFs in the U.S. that track foreign indices, you got to be careful with a rising dollar because that will eat into the performance. So, for instance, if you really like the German DAX and you buy the EWG, which tracks that market, in a rising dollar environment, the EWG will not perform as well as the German DAX. So you have to understand that there is a currency effect on some of these ETFs that you trade overseas. So just make sure you understand that. But again, I would defer to the master of the international markets, which is John Murphy.
Absolutely. All right. Well, what's this poll telling us?
Yeah, the poll. Yeah, this is pretty interesting. So I wanted to see.
Too.
What's that?
I think it's really interesting too. I would not have expected the scooter at the top.
Well, I tell you what, as much as we talk about it and as much as, some of our fellow commentators write about it here at StockCharts, I'm not shocked.
Mm-hmm.
And it is an exclusive feature here at StockCharts. You can't get that anywhere else. So, but the one thing I like is that everything is being used.
Yes.
So I wondered if there would be anything like at 10%, and I don't see anything like that.
No, everybody. And it was hard for me because honestly, I could have checked every single box, but I decided to pick my top 3. And the top 3 I went with was, well, number 1 for me is the scan engine. I mean, I could find my stocks another way, but that is just the quickest, greatest way. I love it. That would be my number 1. And then I think I had scooters was number 2, and then the sector industry summary. But I use chart lists because I have, those groups, watch lists, my market summary charts. And then I do use RRG now more than I did. And I have your price relative as one of my chart styles. So I use that too.
Yeah, when I look at this list, I mean, of these 6, I would say the 3 that are most closely related to relative strength would be the scooters, because that's what the scooters is doing, is marking relative strength. So I'm really glad that's number 1. But the other 2 are the RRG and the price relative charts, and those are at the bottom. So I would say if there was one thing, maybe if we did this poll a year from now, that I would hope would be a little higher, it would be those 2 bottom ones, because there's nothing more important than relative strength. Well, there's not much more important than relative strength when you're trying to perform well in the stock market. So I would hope that folks would use those tools more in the future as we continue to talk about them.
Yes, absolutely. All right, it is time for the 10 and 10, though. We got to move this one along quickly. Our very first symbol is going to be TJX. I'll share just briefly the RRG while you get your computer there set up. I wanted to just show you right here with the tails. And then, when you get these outliers, there's a way to get around that too. You can go ahead and take them out by just unchecking the box, and then you might be able to get a little bit better look at the ones in the middle. But right now, today, technology is the winner as far as our requests. But let's start with TJX.
All right, TJX, and we're talking about an apparel retailer. And so on this chart, the one thing I annotated, I mean, it's been going up and it's holding the rising 20-day. Actually, I'll go ahead and add that as well, because I think that's important, that each time we fall back, we are holding on to that key moving average. And I love in trending markets using the 20. I mean, we could go back here and you can just see on just about every single time you test a 20-day in a rising environment, you bounce off of it. So, when I'm looking, and that's where you can keep your stop the tightest, because if you close much below, and I would say maybe, 1% below or something like that, give it a little bit of room, because we did actually have this one day right here. We went a little bit below, might have gotten stopped out there. But other than that, this has been a tremendous indicator on when to buy into TJX. So I think that's something to watch. But the other thing is that TJX is a strong performer relative to the apparel retailers. So if the group begins to catch fire, and it's been doing pretty well on an absolute basis, doing maybe not quite as good on a relative basis, just kind of going along for the ride with the S&P 500. But if you start to see the group breakout, you have one of the leaders with TJX. So I think that 20-day test, along with the relative strength, are the two things I would, keep an eye on here.
All righty, let's see. The most popular in the chat room was, fortunately, the most popular, because we look at it too much, Tandem, TNDM.
All right, Tandem I own still. So I bought it down around, 61, I don't remember exactly where it was, but recently on this move down. I've talked about this one being very strong around that 60 level. I'm going to shorten the chart just to try to see if we can see those candles a little bit better. Okay, yeah, it's having a good day. A close back up above the 20-day today would be very good news here. But I would just mark this area of support right there. See, after the big gap up with earnings, how we went back down and right around $60 was support. Notice each time we get back down here, I think that is a key area of support where you can manage your risk to the downside, maybe make $14 to the upside while only keeping, maybe a buck or two downside risk. But I think TNDM looks good. I like the chart here. And again, full disclosure, I own this one.
All right, good one. All right, let's look at VIAV, and that's telecom equipment.
Yeah, great space, and I think you're starting to see this turn back up. I believe you got a cup here forming. So I really like the chart here. I like the group. So let's just point out a couple things here. First is the huge move here, but not just a huge move by the stock, also a huge move by the industry group, and a huge relative move by the industry group. So that means more than its fair share is coming into the group. And as long as that's happening, you got a much better chance in a stock that is performing well, like this one has. So I think what you've got here is kind of this cup forming. I expect you're going to get back up to about 1350 on the stock, maybe go sideways for a bit, but I'd be looking for a breakout. I think it looks really good.
All right, let's see. The next one was very popular, so we'll go ahead and look at it. AT&T.
All right, AT&T. All right, first thing, price breakout. So that's the thing that stands out to me. But the group relative to the S&P, not exciting. So as maybe an income type of an investor, I might be a little excited here because now I'm getting a little capital appreciation to go with a really nice dividend on AT&T. So that's good. You got a little bit of volume coming in on this push. Those are the good things. The bad things, when I look down here at the bottom, in 2019, we started up here on a relative basis, and now you can see where we are. So, relatively speaking, we haven't really gotten that breakout. So yes, absolute breakout, but not a relative breakout. We keep failing right at about this area. So again, good dividend performer, nice capital appreciation with the breakout, but I don't necessarily think you're going to have an outperformer here. So mixed bag for me on AT&T.
All right, how about Exxonmobil?
All right, unfortunately, it's going to be in that area in energy, which has just kind of been going sideways with the S&P at best, even trending lower. And again, I'll get back to my dollar discussion earlier. We're in a rising dollar environment. Less money is going to go into these energy and material stocks. And so as a result, the thing that bothers me the most is perhaps a continuation of this trend to the downside. And you can see it had been trending lower throughout the end of 2018 into early 2019. So after 1 month of outperformance, we're rolling back over again. I would just simply be careful if I was in it. Notice again here the rising 20-day tests. One there, here, 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 here. I mean, you kind of get the point. As long as we keep holding that 20-day, I'm okay. But if we start to see tactical failures, remember the group that you're in. It's a weak group.
Okay, let's see. Next one up is going to be CAMT, and that is Camtech. It's in the electronic equipment industry.
Yeah, light volume at times. So just kind of keep that in mind. I don't know that it's overly light, but sometimes it looks like it trades less than 100,000 shares, which is a little bit problematic for me. But I do like the overall group, and I really like the breakout here. I mean, this is a perfect ascending triangle, really. If I pull up the rising bottoms here, you can kind of see that that has been moving up off of an uptrend, heavy volume. We got the breakout with heavy volume. Best entry is clearly down at about 930. If this stock were to pull back for whatever reason in the near term, 930 would be my entry point.
All right. Next up, Cisco.
Is that the Cisco Systems?
Oh, yes. I'm sorry. CSCO.
Yep. Just want to make sure.
Yes, that's a good question. Sorry.
Yeah, this is one of my favorite stocks. I mean, I love this stock for 5 reasons, and I'm going to show you all 5 of them right here. 1, whoops, not in black though, in blue. 1, 2, 3, 4, and 5. A great stock within a great group normally is going to result in outperformance. So as long as that continues, I would be an owner of Cisco. I like Cisco.
Okay, let's see. Next one up, the Emerging Markets ETF, EEM.
Yeah, this is one you got to be careful with the dollar. It's been performing well, but it's going to be held back a little bit by the rising dollar. I can pull this up on a regular chart. Yeah, I think we either looked at this one or one very similar, but there was your sideways consolidation off of an uptrend. Here was your uptrend, sideways consolidation breakout. It looks good. I think if we, I'm going to go ahead and just stop there on the annotations, but I do want to show you one other thing here about this EEM, and that is if I were to pull this up relative to the S&P 500, and let's just go back the last few years, solid line chart. Look at the relative weakness. So we're getting a breakout, but the breakout's being held back a little bit by the rising dollar. And look at how it is underperforming the S&P 500. So my problem isn't so much with the absolute chart, it's with the relative chart. And again, is when the dollar's rising, I prefer staying away from these ETFs that are affected by the currency. So I would avoid the EEM personally.
All right, let's see the next one. The request was to look at a weekly chart for H&E equipment, and that's HEES. It's a commercial vehicles industry.
All right. Well, I can use my candles here. Okay. Well, huge move down. I really don't like this. I think we had a breakdown at $32. We've gone up and tested it, and we've rolled back over again. I'll show you here on the chart what I'm talking about. So here is your support, and it was violated. Got close there. Definitely tested here. Nice little hammer on that one. You can see there and here. So 32, I think, was pretty important support, and we went right through it. And look at the volume. That is the confirmation for me. So you got a little bit of a head and shoulder top, left shoulder, neckline, head, neckline, just sitting over here on the right shoulder, and then we break down. Notice when we come back up, where do we fail? We fail right at that prior price resistance, or excuse me, prior price support, which then becomes resistance, and we roll back over. I am not a big fan here. Until we can get back up above $32, I'd look elsewhere.
All righty, let's see one more, and that is going to be an ETF, Alternative Harvest ETF, MJ. I'm kind of guessing what that Alternative Harvest might be by their symbol.
All right, Alternative Harvest, MJ. I think it's consolidating. I mean, I'm just kind of looking for a pattern. I don't really see a pattern here, but, you know, off of an uptrend right there. And this was the reaction high. So what you have here really is a move up, a pullback, another move up. Now, I don't consider this pullback because you never broke out. So you didn't put in a new high. Here's the new high. So high, pullback, high, pulling back. I think as long as we hold 33, we're okay. I would view this just in a trading range right now between 33 and 39.
All right. There you go. That completes the 10 and 10. Here are the stocks that Tom just annotated charts for. I'll have these up in the Market Watchers Live chart list. Just go to the Articles Blogs tab, click on the Market Watchers Live blog, and the link to all of these charts will be right there at the top for you. All right, let's go ahead and get started with our final market update. All righty, let's update these charts. Obviously not the best day going on right now in the market. What we're seeing currently is markets down. Of course, Dow Jones down. Most of the major indexes you can see gapped down on the open and are now trying to pull out of those intraday lows. Looking good so far in terms of that move to the upside, because we're looking at rising trend channels right now on a lot of these. S&P 400, though, is starting to move back down toward its intraday low. And you can see that the Russell 2000, same thing. We just, in the last 10 minutes, got a little bit of a gap down there. Right now, the Canadian markets are following suit with the S&P 500. You can see looking very much the same. Treasury yields are lower today, 2.501% currently. VIX is rising, and we are seeing a reading of about 1379. UUP is mostly unchanged. It's only down 1 cent, but lower on the day. And gold, big gap up and now consolidating sideways. Looking at the last 3 trading days, you can see gold is now trying to get back into a rising trend. USO is lower on the day, $13.32. And look at bonds, giant gap up. Starting to pull back, though, a little bit here, but still a really nice move to the upside. It is up 45 cents to 124.04. And then finally, a look at what our sectors are doing right now. Currently, the only one in positive territory is the communication services sector, followed by utilities, which is down 0.06%, not that far. Industrials, though, down, really taking a hit, down over 1%, and energy not far behind, down 0.82%. That's all I have, Tom. I'm going to pass it back to you.
All right, just wanted to point out a couple things. Number one, on the Nasdaq, after moving up to on April 3rd, you can see we've really struggled here a little bit. Actually, the chart didn't come up through. Hold on 1 second. All right, let's try that. You got it now?
Yes.
Okay. Yeah, off of this high on April 3rd on the Nasdaq, you can see we've really struggled to go any higher. And check out the negative divergence on the 60-minute chart. So a pullback, you can see the 50 coming up pretty rapidly. If I were to annotate, I think you have really good support around 78.50 in the near term. That would be this gap support that we tested and held. And then also the 50-hour moving average, which currently is at 78.79. So those are the 2 levels on the Nasdaq that I would look for on any kind of a pullback if we do sell off. But I do also, and I'm going to switch now over to the S&P 500. So let me pull up the S&P 500 chart while I tell you this. Since 1950, the 7th to the 10th of the calendar month has produced annualized returns of minus 5.78%. And you might say, well, that's just 4 days out of the month. That's not really meaningful. It accounts for 2,312 trading days, which is the equivalent of about 9 years worth of trading data. So imagine going 9 years, averaging losing 5.78% per year. That would be pretty devastating, I think. And that is the equivalent of what's happened from the 7th to the 10th of the calendar month. So what we're seeing right now is typical. I'm not going to try to tell you that it happens every month. It does not happen every month. But it is a tendency for the market. We tend to see money come into the market to open a month. And then once the money comes in, then I think we go through a profit-taking period. So the 7th to the 10th, just keep in mind, this could be nothing more than what we typically see on a historical basis. Okay, Erin, let's head into the final segment. I talked a little bit about scooters earlier, and I know you got a scooter report. What you got?
You betcha. So I decided today, and interestingly, I think it does go kind of with hand in hand with what you were talking about earlier. I have a scooter scan, and it's kind of general at this point. Actually, I did add 7, 8, and 9, these 3 lines. I didn't even have those in my scan originally. But when I ran it, and I will publish this scan in the Market Watchers Live recap if you want to copy it. And you know, what I found was, and I'll run this scan and you'll see what I found. 85 results. I don't have time to go through 85 results, especially right before the show, to give you a really good look. So I decided it was time to go back and maybe narrow this down. And how did I choose to do that? Well, one of the things I talked about at ChartCon and what Tom just touched on is I want to find the sectors that are looking good. And that's a really easy way for me to focus this down. Because if you note, when I run the scan, and again, I'll just run it really quickly again, look at the sectors and which ones come up. Lots of discretionary, actually a pretty healthy amount of financials. But the ones that really are leading, of course, I thought, looking at it, and the ones that seem to be starting to lead the rally to the upside was consumer discretionary and technology. So I went ahead and decided I want to focus this scan. Fortunately, I have a focused PMO scan that I'm just going to copy right from. So for me, in this scan, I focused it down to cyclicals and communication services. Well, that's not exactly what I want, but this at least will get me close as far as the code. So I'm going to just copy it. I'm going to go back to my scan. And now I'm going to actually, I'm going to add it, but it really, I don't need these first two lines anymore when I add this, because we're only looking at a few sectors. So we know it's going to be a stock. We know it's going to have decent volume. And of course, we know it's a US stock. But I don't really want to mess up my scan just yet. So I'm just going to post it in here. I'm getting that X because I need to have an and in front of this. So I'm going to fix that. And then remember, I want cyclicals, but I don't want comm services. So I'm going to just go ahead and take comm services out and start typing technology. I just got the T in here, and you can already see it's giving me the opportunity. This is a great, the advanced editor is awesome. So it did all of that, but it put in an extra sector in there. So let's try that again. And I'm going to say, let's do it that way. Now it'll work better. Technology sector, pop, there it is. And it's showing a yellow because whenever you use an OR, you just need to be careful and understand what it is. This is, you know, I want it to be in the cyclicals or the consumer discretionary. I can't say and because you're not going to find any there in both. So I need to do the OR. But you have to realize when you do an OR, you're actually opening up your universe of whatever it is you're looking at. Because, you know, with the ands, you're constantly focusing down. But when you add an OR, you have to think about that. You're adding a whole nother group or a whole nother universe or a whole nother set of indicators. Just be aware what the OR clause is about. So anyway, I've now narrowed it down to those two groups. And now let's run the scan and see what we have. Oh, I have a syntax problem. Oh, that's interesting. All right. Okay. I am not sure what I did here. It must have something to do when I added these up here. Yeah, looks like I have an extra one right there. There we go. That hopefully will fix the problem. Yep, that worked. Okay. So now I'm going to run it and let's see what we get. Oh, 31 entries, much better. That's much, I can handle that. So I'm going to go ahead and put this in a chart list because I want to look at it using Candle Glance, and I can't do that unless it's in a chart list. So I have my scan dump. This is that transients that I put in here, the transient stocks. I put stuff in this chart list that I know I'm never really going to save. So I never keep anything in here that I don't mind losing. So that's all I have in here is the stocks that I don't mind losing. So now we have our list of the discretionary and technology portions of my original scan. And like I said, I usually go straight over to the Candle Glance And this helps me by looking at my PMO. I get to see the 20, 50, and 200-day EMAs. It's set up very nicely for me. If you would like to do the same thing and have your candle glance look a certain way, all you have to do is set up your chart the way you want it. And I will show you by using my chart style here. And you save it as candle glance. And when you do that, you get your candle glance set up. So for me, again, I want it somewhat smaller. I want to see the PMO and I want to see my EMA. So that's how you set up your own personal candle glance. So you set it all up the way you like it and then save it as exactly this candle glance, and that's how you'll get it. All right, so let's go back to our candle glance though. All right, so I was looking through these and I was trying to find the ones that were interesting to me. Let's see if the 5 I wanted to look at are still here. I have to say what I really was looking for is either the chart pattern. Typically, I look first at the PMO. I want to see that it's going the right direction more so than anything else. It's nice to see a buy signal in here. It's good to see maybe you don't have the buy signal and you're starting to move up toward a buy signal. These are all the things that I want to look for. And like I said, primarily, I'm looking at the PMO and the setup of the EMAs and then the chart pattern. And then when I find something interesting, then I take it to my big daily chart and I look at the volume and the scooter. So the first one that popped out to me was Dollar General. And why did it pop out to me on the candle glance? Well, I had a PMO buy signal and I have what looks like a flag formation. And of course, my 20 is above the 50 is above the 200. So we're already in a nice swing to the upside as far as Dollar General. So that was one I found interesting. Also notice that it's pulling back, and it's pulling back and sitting right on that support level. In fact, I will annotate that for you quickly here. So look at that. If I put that right at that high, we're sitting right on it. So if I can hold that support, I'm already looking at a possible flag formation here, and I've got the PMO buy signal. Yes, the PMO is starting to decelerate. Well, of course it is. It's pulling back toward the breakout point. That's to be expected. So I'm going to watch that support. If we can get a bounce, that would be great. But, you know, with it already being down just under a percentage point here, my thought is I could very easily get into this. I would be okay with that because I could set my stop very tightly as far as the short term. But if I get that move to the upside, I would expect the support level to hold. I can raise the stop and start looking for that nice move to the upside. And let's go ahead, and I'm not saving them because remember, I'm in my scan dump. It just doesn't do me any good because I'm going to probably erase it in a short period of time. Let me look at the weekly just to show you what we're looking at here. It looks pretty good. Obviously, you've got the buy signal. And then if we look at it on a monthly chart, it's still looking really good in the long term. And it is continuing right now to make all-time highs. All right, so let's go all the way back, though, to our candle glance. And here we are. The next one that I found that was interesting was GWRE. Is that, yep, Guidewire is still in here. Similar situation. So I'm on the buy signal. I got the bull kiss here. It came back down, was the fake out, and now it's starting back up. And like I said, we're getting a little bit of a flag formation. I'm guessing that's a pennant, but let's go look closer. All right. Not really a pennant here. And it looks like it's still in the flag. It's forming the flag right now in that consolidation zone. But we are on the buy signal. And like I said, we got that move back. Scooter is starting to look good in the hot zone. And you can see that volume, the OBV, is going in the right direction. You know, we had that big pop on it that gave us that move right here to the upside. But it's been steadily rising on the volume. So I like that. I think it's a good setup. And again, flag formation, if you wanted to just do a quick calculation of minimum upside target, if you got a breakout here, well, it's about, as one of our guests said, 3 handles up. So if we look here at the breakout and go up about 3, we'll certainly be testing the all-time high on GuideWire. So I think GuideWire looks pretty good right now. Let's see, next one up that I'll look at, IT was another one. Is it still on here? There it is. It's right next to it. Gartner Group. And this one you can see it's been a really nice rising trend. It's still heading upward. And again, another what looks like a flag, only this one executed 2 days ago. And we're just getting a follow-on rally after that breakout. And look what that breakout landed up next to right here at that prior, the setup for the resistance here on that flag. But we got the breakout for the flag, and it's above that previous overhead resistance at the November high. So I think this one's set up nicely. And if you look, maybe you might think that the PMO is overbought, but I suspect we're looking at a -4 to a +4 as far as the, let's see, the range. So let's just take a quick peek, make sure I'm right, and then I'll start wrapping up. Yep, pretty much, although I can see that before we had some of these wild swings from +4 to -4, really the typical range was running here between about 3 and -3 is what I'm looking at. So it is overbought, but I think we still have a chance for it to come up here and test that high back in the 2018 high. I think that looks pretty good. And then let's see, I had 2 others, but I'm not going to have time to go over both of them, but I'll tell you what they were. The first one was MTSC, and that's not on here anymore. So I know that we're going to look at MXIM. And this one I liked. Again, you had the buy signal. You can see that the EMAs are just now crossing each other to the upside and now are lined up in a bull market setup. So let's look at this one just a wee bit closer. And as you can see, again, flag forming. Again, those EMAs set up the right way, the buy signal. And we are certainly not really, I would say, not overbought yet on the PMO. And Scooter is almost there to the hot zone. Overhead resistance back here at that all-time high. This is the area that it's breaking out of above that high, which is also a positive. And it's pulling back by 1% today. So that's pretty nice to see. All right, excellent. That is all I have for the Scooter report. Here is basically what I went through and how to do it. And I will print the scan in the Market Watchers Live recap. You can go there and get links even to our show from there. So go take a look at the Market Watchers Live recap and blog.
All right, good job.
Thank you. I think this was a lot of fun, this show. And I think, you know, we already got a lot of comments in the chat room, Tom, that may be the best ever workshop you've done.
Wow. Okay.
Yeah.
Well, I appreciate that. Yeah, definitely. You know, when you're done and heading out, the video player is down at the bottom. Or excuse me, the survey is at the bottom. It's located right below your video player. Just, you know, shoot me a line or 2 just to fill out that survey and let me know what you thought of the workshop. And if you approach it a little differently, I'd love to hear that too, because always looking to improve on relative strength, you know, evaluation of the market. I think it's really important. Every guest, Erin, that we've had on here talks about relative strength.
Absolutely. I mean, that's why I have a Scooter on my chart default.
No doubt about it. No doubt about it. All right, we got a couple of big guests coming up. We are going to wrap up here. Do want to just mention that the Dow Jones Industrial Average currently is down about 175 points. And leading to the downside today is Caterpillar and Boeing, both down more than 1.5% today. All right, I want to thank all of you for being with us today. Please remember to complete that survey I just spoke about as you exit. It is located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We're 2 days away from the Masters. See you back here tomorrow. Happy trading.